Jai Shri Krishna. Hello everyone. I am Ajay Punna, your mentor. We are currently dealing in risk management course. In the previous video, which is the first video, we have discussed about risk and different types of risks. We saw that risk is an impediment to the achievement of organization's objectives, wherein impediment means an obstacle which a company or any business organization is or going to face so that the achievement of its objectives become difficult. Further, we saw risks are of two types based on the predictability and controllability, which are systemic risk and unsystemic risk. Systemic risk is related to market, and unsystemic risk is not related to market, but it is specific to the individual business firm. Systemic risk affects a larger number of organizations, while unsystemic risk affects only that particular business entity. Unsystemic risk can be controllable. However, systemic risk cannot be controlled. Further, we saw risk can be divided into financial risk and non-financial risk based on the impact on financial aspects of the entity. Right? We saw financial risk is such a risk, okay, which have a direct and immediate financial impact on the entity, whereas non-financial risk do not have a direct and immediate financial impact. However, if they are not managed in the initial stages, it can cause very serious, okay, problems to the business entity. In today's video, we are going to discuss about financial risks and different types of financial risks in detail. In further videos, we will see non-financial risks and different types of non-financial risks. And further, we will move into risk management process. You are with me? Let's start. All right. Let us discuss about the meaning of financial risk once again. Financial risk, okay, is the risk that actual return on investment is less than the expected return. Right? So this particular possibility or probability is a financial risk. Financial risk will have direct and immediate financial impact on the entity. Right? That is about the meaning of financial risk. Now let's discuss about the different types of financial risks. There is an acronym for this. Okay, I remember like this: M for lock. Right? So using this acronym, I'll try to make the list of types of financial risks. Types of financial risks. Right? First one stands for market risk. Second, political risk. Third, operational risk. Fourth, liquidity risk. Fifth, we have legal risk. Sixth, O stands for obsolescence risk. Obsolescence risk. Lastly, C stands for credit risk. These are all different types of financial risks. Let's start with market risk. I'm choosing a different pen here. Okay. Market risk. What is market risk? Okay. Market risk arises out of, okay, market ups and downs, right? So whenever the market is going up, for some it may be good, for some it may be bad. For bearish traders, when the market goes up, it is a risk for them. But for the bullish traders, when the market goes up, it is profitable for them, right? Or when the market goes down, for bullish traders, this is a risk. And for bearish traders, it is a profit, right? Formally, we can define market risk, okay, arises out of the changes in four things. Okay, I'll write about it. Market risk arises out of the changes in, I'll write pointwise here, interest rates, currency rates. Currency rates can also be called as exchange rates. Then equity prices, and we have commodity prices. So whenever the rates go up and down, up and down, up and down, right? For some it is profit, for some it is loss. We will discuss about this, okay, in detail. So we can say market risk can further be, okay, subclassified into four type of risks. Interest rate risks, currency rate risk, equity risk, commodity risk. Let's start off with interest rate risk. We can define that interest rate risk arises out of, okay, ups and downs in the interest rates, right? See, interest is based on the benefit, okay, for lending the money, right? So there are two types of parties, lenders, right? And then there are borrowers, right? Borrowers can be issuers, such as companies issuing, okay, bonds and debentures. There can be investors. For lenders, the risk is, okay, if the interest rate, okay, goes down, this is a risk for them, okay. And whereas for borrowers, if the interest rates go up, this is a risk for them because when interest rate goes down, that means returns are less for the investors or lenders. In the same situation for borrowers, when interest rates go up, they have to pay higher interest, so their returns will go down. But depending on the type of party, okay, the movement in the interest rates can decide the profitability of that particular party, right? One point I want to mention here, interest rates are inversely proportional to the price of the fixed income security. Fixed income security. If your fixed income security can be like, okay, the debentures, bonds, or any securities issued by government. Second is currency rate risk. As I have mentioned, currency rate risk can also be called as exchange rate risk, right? Again, there are two parties involved. I can say exporters and importers. For exporters, if the exchange rate goes down, this is a risk for them. For importers, if the exchange rate goes up, it is a risk for them. Let's take an example and understand. Let's suppose the current rate, spot rate of dollar against rupees is, let's suppose, rupees 80 per dollar. But if the future rate is 75 per dollar, it is a loss for him because for every dollar he's exchanging today, he would get 80 rupees. But if he is exchanging the same dollar in future, if if the exchange rate has decreased, he will receive lesser Indian rupees. So this is a loss for him, right? So that is again a risk. But when it comes to importers, okay, the situation is reversed. For example, okay, I'm taking the same spot rate as, just a minute, rupee 80 per dollar. Let's suppose 3 months later, the future rate will be 86 rupees per dollar. Now he has to pay 6 rupees extra for every dollar of payment he has to make. Right? Again, this will cause a loss for the importer. Right? Obviously, there are ways to hedge this risk. Okay. There are various options available to mitigate the risk. Okay. Right. Next. Third type is equity risk. Equity risk is faced by, obviously, investors, right? But investors are of two types, okay? Bullish investors, bearish investors. For bullish investors, risk is whenever the equity prices go down. So is expecting the equity prices to increase, okay, to get the capital gain profit. But here, if the equity prices go down in future, that will be a risk of loss for him. But on the other side, bearish investors expect the stock price to go down. So if the equity prices go up for them, it is a risk of loss. Right? So how to define equity risk? Okay, we can say that the risk arising out of changes in equity prices. Right? Let's move forward. Then we have commodity risk. Commodity risk, okay, arises out of changes in prices of commodities. Right? Commodities can be like gold, silver, okay, copper, or any, okay, food produce, etc., etc. Right? The same type of investors, okay, can also be, okay, in the commodity market. Bullish investors as well as bearish investors. For bullish investors, if the commodity prices go down, that is a risk for them. On the other hand, for bearish investors, if the commodity prices go up, it is a risk for such investors. Right? So that is about the four subtypes of market risk. Right? Market risk can be expressed in absolute terms, which means in rupee terms, or it can be, okay, expressed in relative terms, okay, such as percentages or indexes. Right? Second, we have political risk. Political risk can also be called as country risk. As the name itself suggests, this risk arises out of political uncertainties, change in governments, right? Political disturbances, or simply we can say any political events, etc., etc. So such political uncertainties or changes in the government, okay, of any investee country will pose a risk to the investor, okay, who is in the domestic country.
right? Then we have operational risk. Operational risk can also be called as system risk, or can also be called as management risk. As the names itself suggest, this is relating to managing the operations efficiently. So risk arising out of system failures, poor management control, insufficient system controls, etc., etc. Basically, a poor management, a poor operational decisions, poor operational planning and execution. Right. Next, we'll talk about liquidity risk. Liquidity risks arises when there is mismatch of cash flows. Mismatch of cash flows. Simply, it also means that there are inadequate liquid assets. Liquid assets are such assets which can be converted into cash, which can be converted into cash in a very short period of time. Very short period of time. So usually we call this as cash and cash equivalents. In order to say simply, cash and cash equivalents, if cash and cash equivalents are not available, liquidity risk arises. All right. Now this liquidity risk can be classified as what? Liquidity risk is classified as trading risk and funding risk. Right? Trading risk, a risk that the funds, or let me say, risk that the products are unavailable, leading to difficulties in buying and selling. Trading itself means constant buying and selling, process of buying and selling, right? Now, funding risk is the risk that the financial obligations are not met due to insufficiency of liquid assets. You might have heard about recent Silicon Valley Bank. Okay, so that was facing this funding risk. Silicon Valley Bank. Right. Then we have obsolescence risk. Obsolescence risk. Obsolescence risk, okay, is a risk arising out of rapid changes in the world, right? If the business entity, if the entity do not update itself with rapid, okay, technological developments, it will face obsolescence risk. Recent example is Nokia, right? I want to explain, okay, a little bit more about this obsolescence risk. Movie theaters face obsolescence risk from OTT platforms. Okay, because this is the trending thing now, right? The traditional movie theaters format, okay, will face the obsolescence risk, okay, from the OTT platforms, right? Publishing houses face, okay, obsolescence risk from digital gadgets, which allow, okay, direct PDF reading, right? So if traditional, okay, books are printed, okay, obviously there are advantages with traditional books. However, that industry will face the obsolescence risk from the digital gadgets, which allow e-reading. Okay, so recent example is Kindle, Amazon Kindle. Right? We can take an example of Netflix, Prime, etc. Lastly, we have credit risk. Okay, credit risk arises out of the possibility of default by borrower, okay, or debtor. So the default possibility leads to credit risk. Okay. So how to mitigate credit risk? Mitigate credit risk through credit check. Okay. If possible, take collateral, surety, right? Other ways, right? I think we have left out legal risk. We'll discuss about the legal risk as well. Okay, obviously, as the name suggests, I can say or define this as a risk arising out of ambiguity, okay, in law, or failure to recognize the applicability of law to the entity, right? Any okay, changes in law, okay, can also, okay, lead to legal risk. Obviously, when there is ambiguity and failure to recognize, okay, this poses a financial threat in terms of penalties, okay, and other fees and charges, right? So we have discussed about financial risk and different types of financial risks along with examples, right? In the next video, we will discuss about non-financial risks and different types of non-financial risks. Also, we will cover audit risk and risk management process in the upcoming videos. Thank you, everyone.